All right, let's jump right into this comprehensive explainer. Today we're connecting network fundamentals to global macro forces, and then tying it all back to trader psychology to really make sense of the chaotic 2026 crypto market. We're looking at a landscape that is evolving incredibly fast, and to truly understand it, we need to look at the structural foundation, the broader economic weather, and the mind of the trader, all at the exact same time.
Here's our quick roadmap for today. First, the base chain economy. Second, AI agents and SocialFi. Third, we'll weigh bull versus bear markets. Fourth, navigating liquidity traps. And finally, number 5, the psychology of overleverage. Let's get into it.
Starting off with Section 1, the base chain economy. We are exploring Coinbase's explosive Layer 2 network.
$7.8 billion. I mean, that is a massive number. That represents Base's total value locked as of March 2026. And what's wild is that this was driven by a staggering 23% surge in literally just a single week. This isn't your standard gradual growth. It's a sharp, sudden concentration of both retail and institutional liquidity just pouring directly into the network.
And if you look at the revenue share, it gets even more interesting. Base is capturing nearly a quarter of all Layer 2 revenue. That's generating over $196 million purely through organic usage. Unlike other networks that essentially, pay for users through really heavy token incentive programs, Base is pulling this off without even relying on a native token. People are using it simply because the infrastructure itself is efficient, it's cheap, and it's directly integrated with Coinbase's massive user base.
This breakdown really paints a picture of the diverse pillars holding up the Base city. The economy here isn't just a one-trick pony. You've got deep DeFi liquidity anchored by Aerodrome Finance acting as the main hub. Then you have the SocialFi sector with Zora and Farcaster completely transforming how creators monetize their content and build on-chain identities. And of course, there's a highly active retail sector with roughly $300 million in sustained meme coin activity. It's truly a fully functioning digital ecosystem.
Moving right along to Section 2, AI agents and SocialFi, the rise of the agentic economy. So here we can see a really striking contrast between traditional speculative retail trading and the incredibly sophisticated new DeFi sector. On one side, meme coins rely entirely on human emotion, hype, and short-term community volume. But on the other side, we have DeFi, decentralized finance paired with AI. And guys, these aren't just simple bots. They are autonomous economic actors managing their own wallets, making logical decisions, and executing complex strategies entirely on their own. By leveraging Base's sub-penny fees and lightning-fast block times, these AI agents like a Chixbit and Luna built on the Virtuals protocol are acting as highly coordinated financial players right alongside human users. I mean, they can hold funds, autonomously verify their identity, execute token swaps the exact moment market conditions shift, and even make pay-per-request payments for API services. We are looking at an entirely new class of network participant that literally never sleeps. All right, zooming out to Section 3. Bull versus bear markets. Let's navigate the macro weather.
This perfectly maps out the current battlefield we're in. On the bearish side, we've got some very valid anxieties. Fears of an AI valuation bubble, sudden tariff-induced market crashes, early Bitcoin adopters deciding to sell off, and late October ETF outflows. But then, look at the bull case right next to it. We have central banks actively cutting interest rates, over $300 billion in stablecoins just sitting ready on the sidelines, and a massive structural tailwind of over $30.2 billion flowing into Wall Street spot ETFs. It's a major tug of war right now.
And you can see these macro headwinds directly affecting the biggest players in the space. Take Coinbase, for example. Their Q1 2026 revenue missed Wall Street's top-line estimates, coming in at $1.34 billion against an expected $1.42 billion. Why did that happen? Well, primarily because of much quieter spot market trading. Bitcoin spent a lot of time consolidating, which naturally means less retail frenzy and lower transaction fees for the exchange. But, and this is a big but, the crucial point is that their institutional derivatives volume surged 169% year over year, hitting $4.2 billion. So while retail spot trading might have taken a little breather, institutional players are quietly and aggressively scaling up their derivatives positioning. The underlying structure of the market is absolutely still growing. To complete the macro picture, we have to factor in external catalysts, like these ongoing geopolitical negotiations. Tensions in the Middle East and rebuffed diplomatic proposals are keeping WTI crude oil prices highly volatile, right around $95 a barrel. And this matters immensely to crypto because oil impacts global inflation, which dictates central bank policy, which in turn drives critical economic data like the U.S. non-farm payrolls. It's all connected in one big web.
Let's bring it back to the micro level with Section 4, navigating liquidity traps, smart money tactics.
Let me ask you something. Have you ever bought a breakout that looked absolutely perfect, only to watch it instantly crash the second you entered? Yeah, we've all been there. That's not just bad luck. That is a liquidity trap in action. Large institutional players need massive liquidity to enter or exit their positions, and they know exactly where retail traders like to place their stop losses. This step-by-step sequence shows exactly how smart money uses the predictable behavior of retail traders to fill their own massive orders. First, they push the price just past an obvious resistance line. Retail traders see that breakout and rush in with major FOMO. Then, once all those retail buy orders provide the necessary liquidity, the institutions sell their massive positions right into that buying pressure, causing the price to sharply reverse. Boom, trap sprung.
So how do you actually survive this? Instead of blindly chasing a green candle, use these specific defensive tactics. If you see a breakout with a sudden volume spike but zero follow-through, or a candle with a really long wick that immediately gets rejected, you need to be on high alert. Wait to see if the market actually holds that new level instead of chasing the very first breakout. And a pro tip, always place your stops just outside the obvious pools where you know everyone else is placing theirs.
Which brings us to our final part, Section 5, the psychology of over-leverage, the mind of the trader. Think about this for a second. Why do losses hit us so much harder than gains? In behavioral psychology, this is known as loss aversion. The psychological pain of losing $100 is literally twice as intense as the joy of making $100. This fundamental emotional imbalance forces traders to behave completely irrationally. When they take a hit, they instinctively start chasing high returns through rapid, over-leveraged trades just to quote-unquote recover quickly, and that almost always ends in disaster. These exact psychological blind spots directly fueled the recent liquidation storm, where over $1.13 billion in positions were wiped out in a single 24-hour period. It usually starts with overconfidence after a few good trades. Then it gets amplified by social media hype telling you you're missing out. And finally, it's compounded by severe mental fatigue from just staring at 24/7 crypto charts. Your logic shuts down, and your emotions grab the steering wheel. To counter this, you can't just rely on sheer willpower. You need hard systems in place. For both individual traders and crypto-friendly businesses managing treasuries, implementing these structural safety nets is the absolute only way to survive. Set strict caps on your leverage that you cannot manually override in the heat of the moment. Use isolated margin accounts so one bad trade doesn't drain your whole portfolio. And always keep a healthy chunk of your liquidity secure in stablecoins so you're never forced to sell assets during a market panic. I want to leave you with this final provocative thought from our sources today. When you're looking at a chart, try to change your internal dialogue. Instead of asking, "Is this breaking out?" you should begin asking, "Who benefits from this move?" Will you continue to be the blind liquidity for someone else's smart money? Or will you develop the patience and the structure to see the market for what it truly is? Think about that the next time you're hovering over the buy button.